How are you folks, and welcome to another episode of BayView Views. Today I want to provide a brief but kind of meaningful overview of where we are in the Fed Reserve's current monetary policy cycle and what the next steps might look like, how they might align or misalign with their kind of broader responsibilities. So let's begin with the Fed's kind of what we call the dual mandate. Simply put, the Fed is tasked with maintaining full employment, right? We want to ensure that as many people who want a job can get one. And then, of course, price stability, which refers to keeping inflation low and predictable. And ideally, you hear a lot around their target of around 2%. Now, these two goals can many times be at odds. Stimulating the economy to promote jobs risks driving inflation higher, while raising rates to curb inflation can hurt job growth. In recent years, we've seen inflation spike to just over 9%, which of course is well beyond the Fed's target, which led the Fed to shift into a tightening cycle where they were aggressively raising interest rates to try to cool down inflation. But recently, markets and analysts have indicated that the Fed needs to shift to an easing cycle where they're lowering interest rates as the economy growth, slows and inflation comes under control. However, the Fed has found itself in a really tough spot, and it doesn't want to repeat the period of the 70s when Fed Chair Arthur Burns really cut rates too soon, only to see inflation come roaring back. Now let's touch on the Fed's operations and how they've kind of evolved over time. Historically, the Fed operated under what we call a scarce reserves framework. This means that it controlled the Fed funds rate, the rate at which banks lend to each other, by managing the supply of reserves held at the Fed by the banking system. In that environment, consumer loan demand and bank reserves were the primary drivers of interest rates and liquidity. Makes a lot of sense, right? I mean, that's just judging demand in the markets. Today, however, the Fed operates in what we call an abundant reserves framework, where the banking system holds much more liquidity than ever before. Now, this shift happened after the 2008 financial crisis and was reinforced by the pandemic response in 2020. In this framework, the Fed's control over rates no longer depends on banking, lending activity, or loan demand. Instead, the Fed kind of adjusts interest rates it pays on those reserves and uses tools like reverse repos to manage liquidity and set what it hopes to be an effective Fed funds rate. As a result, the Fed's rate policy has become less directly tied to the day-to-day banking activities and is more of an arbitrary number. Ideally, if you think about it, the Fed is supposed to act as a neutral referee in the economy, guiding monetary policy in a way that allows the economy to function as freely as possible, and again, intervening only when absolutely necessary. However, the Fed has been criticized for, again, oversteering, first by being too loose for too long, and now, arguably, too tight. So in response to the pandemic, the Fed slashed interest rates to zero, we remember that, and then they also flooded the market with liquidity by expanding the money supply to try to stave off, an economic collapse. While this helped avoid a deeper recession, it also contributed to significant inflation. And as a result, the Fed began raising interest rates aggressively throughout 2022, 2023. We remember that. Many now argue that they have been overcorrected, right? They're too tight, keeping rates too high for too long, which kind of risks what we call stifling the economic growth and driving up unemployment unnecessarily. So today, the consensus is that the Fed will likely continue cutting rates for the balance of this year, though the exact timing kind of remains uncertain. The current debate hinges on whether inflation is truly under control or if another flare-up is right around the corner. However, the Fed's current messaging suggests that they really are prioritizing price stability, that inflation control, even if it comes at the cost of slower economic growth in the short term. So the big question is, and the million-dollar question, can they orchestrate, again, another soft landing that everyone is really kind of banking on? And the markets are really priced for that, right? We're kind of priced for perfection in the markets today. So in conclusion, the Fed finds itself in, again, a very pivotal moment in the current easing cycle. Their shift from their scarce reserve system to one of an abundant reserves has really changed how they manage policy, and they're making their decisions less data dependent and more nuanced. Ideally, the Fed, again, we want them, they should attempt to stay neutral and kind of let the economy operate as freely as possible. And that's capitalism, right? Letting markets work. Guys, I hope that's helped to bring some clarity to what is an often confusing environment, even the government in general, how their policies work, how the money supply works, and things of that nature. We might do another one on that just to share that. But thanks for watching another episode of BayView Views. Please let us know if you have any questions, or if you wish, we wish you guys to be financially independent and have a sound future. All the best.